Return profile, again, this is similar to our public funds, but the return expectation is higher. We have a 5-year investment time horizon generally. I shouldn't say generally, always 5 years plus. The return expectation is somewhere in the 20 to 25% per year range. Now, for our ETFs in the public equity markets, these are more mature companies, that number is 15%. So again, this is just filling out a space that is where we should rightly be, because we are so focused, exclusively focused on disruptive innovation. So our fee structure, the 2.75% is the relevant number against the 2 and 20. Those other fees, venture capital charges as well. They're embedded. Let's compare the 2.75%, where you have the low minimum and you have liquidity, against the 2 and 20. If you were to compare a fund with our fee structure versus a 2 and 20, and you kept your money in each fund, what you would see over a 5 to 10 year period is that the venture capital fund, and these would be the top tier, where their multiple of invested capital is more like 4.5 times, that the venture capital fees over that time span would be 40% higher than our fees. So we do think we're providing a service here, in that we're comparing against venture capital, not against ETFs, and we're allowing venture access to private companies that just did not exist before, with a low minimum and with liquidity as well. Be fair to the current venture capital firms out there, the best of them, they have been really open to what we're doing, and they've invited us in and introduced us to their best companies at the prices at the last round. They want to help change the world a little bit. They understand the flaws, historically, and they love the idea that we can partner with them. It's not just a one-way street. They're just showing us their best companies. No, we're going to showcase them, and we're going to introduce the world to the CEOs, the retail base, our base of investors, and we're going to help them recruit talent, tell their story, and recruit talent. So it's a bit of a win-win. It's not an us versus them. I would say everyone understands the problem you mentioned, but I think that we're coming together to do this together.
A lot of your market forecasts, Cathie, are really optimistic, which is great. Like, optimism is wonderful. But, going back to that point made earlier, like, there's a fine line between reality and optimism. How do you sort of think about the physical constraints on some of what you're thinking around innovation, especially lithium, and to the point of having jobs available for people within these venture-backed companies? The labor market is historically tight. So how are you sort of thinking about the physical constraints that are happening?
A big part of our research is trying to figure out what is possible. We don't want to be optimistic for optimistic sake. Wall Street and a lot of investing has become very benchmark sensitive. It's gone passive in a way. And so there's less and less research being done. There's no reason for many analysts to follow stocks because they're not in their benchmarks. Those are the innovation stocks that we follow. And I believe that's why we have the best research. We're very focused on innovation and how likely or not will scale during the next 5 to 10 years. Social distribution is going to break down barriers that have existed. Distribution has been a big barrier to entry for a lot of funds, to be honest. As you were saying, Kyla, earlier, non-accredited investors have no shot at venture funds. So Titan is breaking down barriers, and we're grateful for that.
One of the goals with the ARK Venture Fund is information access, right? So bringing the retail investor on board. So how do you plan to help founders through maybe our audience that is all of a sudden watching their every move?
ARK is a very social company to begin with, and I think Titan will turbocharge us in the investment realm this way. We have 3.3 million among us. We have 3.3 million Twitter followers, and they're global. As we do more with private companies and expose them to retail investors through the Titan platform, we're going to be educating them on what we believe are some of the most exciting companies in the world. We've started the fund already with one of the most interesting genomics companies that actually is making progress to identifying cancer in stage 1, if you can believe that, including pancreatic cancer. That company is Freenome. It is in the AI space, and that's pretty mind-blowing. And so we want to, I'm sure gamers are very interested in that. They love the company. It's hard to get access to Epic. We have it, and we can appreciate more what Epic is doing because we're working on the research behind those very, very difficult problems to solve. Innovation solves problems. I always say that. And so we want to showcase these companies as problem solvers and as companies who are going to change the world and really make it a better place. Yeah, and I'll echo, and I say all the time, innovation solves problems. Innovation solves problems. And we have a lot of problems. And actually, innovation gains more traction during tough times because consumers and businesses, if they're afraid, they're willing to change the way they behave. There's a lot of inertia in human behavior, and they're willing to change. In terms of an unmet need, that's why I founded ARK. I saw the traditional asset management world focused on public equities going passive. And at the same time, we saw this explosion of innovation. The seeds were planted a long time ago. The technologies are ready now. The costs are low enough. It's just so ironic. Because of what happened in the tech and telecom bust, people won't go near a lot of innovation these days. That's a good thing. That's a good thing from a portfolio manager's point of view. I know we are not in a hype phase, but I do feel the unmet need that we are filling is innovation as a special asset category because benchmarks and passive are all based on backward-looking indicators. The stocks in those portfolios are there because of their past success. If we're right, and these 5 major platforms, which involve 14 different technologies, are going to disturb, if not destroy, the traditional world order. If we are right, we have a contrarian point of view here. We think the bigger risk in the next 1 to 3 years is deflation, not inflation. And it's both good and bad deflation. We're already seeing cyclical deflation in the pipeline. We've got commodity prices down 30, 40, 50, even oil, 30, 40, 50, 60, 80%. And it's because China's in recession, Europe's effectively in recession, and we think the US is in recession. So you've got deflation coming in the pipeline, and we have a massive inventory buildup that is actually shocking. Nike, for its recent quarter, reported that its sales were up 3% and its inventories were up 44%. In North America, its inventories were up 68%, and the inventory in transit is up 85%. This is going to overwhelm retailers, and the only way they'll clear their shelves is to discount aggressively. We're already hearing Walmart, Target, and others talking about discounting.